Hello, fellow Rebel Capitals. Hope you're well. Silver, woo, heading to the moon, baby. Over $65 an ounce. So this begs the question, is $100 an ounce next? Maybe even more. Let's go into exactly what's happening with not just silver, but gold. Let's look at the charts and see if we can go ahead and come to some conclusions here. So let's go over to, let's just broad strokes, go over to CNBC. They give us some decent charts. Let's take a look at what's happening right here. In fact, silver over $66 an ounce, 52-week high. That's got to be an all-time high. That's absolutely whoa. That's by far an all-time high. I'd be curious what it was adjusted for inflation. Yeah, man. Probably not. Probably not. Well, maybe. Yeah, I would say even adjusted for inflation, now that I'm thinking this through out loud, that would definitely be an all-time high. So by the way, congratulations to all of you who own silver, because I know a large portion of my audience is really big into precious metals, as am I. I haven't gotten to the silver yet. Obviously, I missed the move here, but I have been very, very, very long gold and the gold miners, as most of you know, especially those of you who are members of Rebel Capitalist Pro. I've shied away from silver just because of the yield curve and because the labor market, slowing economy, that should be a headwind for silver far more than gold. That's why I've kind of leaned in the direction of the miners if I want kind of a leveraged play on gold, or kind of that catch-up trade that we were talking about like 3 months ago that worked extremely, extremely well. Just full disclosure, I've been long gold and the GDXJ. I was long GDXJ up until maybe a month ago or so. But look at this chart, guys. Look at this chart. This is, I mean, if anything, you'd want it to take a little bit of a breather here. I know it just did for a couple days, and then it just shot higher. Let me show you what I'm referring to. Go to a 3-month chart, and you can see we got boom, up, 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 all-time highs. Good, 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 at least in nominal terms. And we get a little bit of a breather here, and boom, another all-time. I mean, this is a fantastic chart. Fantastic, fantastic, fantastic chart. This is, you know, I've always said that you want to buy things when they're cheap and sell them when they're expensive. And I maintain that. That's obviously, you know, buy low, sell high. But there's a timing component there that I really didn't understand until this year. And I had a very long conversation. I've had many, many long conversations with my good friend Hugh Hendry when I go to St. Bart's. And one of the things that he told me this year, right at the beginning of the year, that really stuck, or maybe it was at the end of last year, but I've used it this entire year, and it served me very, very well, because in Rebel Capitalist Pro with my own portfolio, we've definitely outperformed the S&P 500 for sure. But Hugh always said, you know, I like to buy things when they're going up, and I like to sell things when they're going down. And some of the best advice I have ever had, the most profound advice I have ever had, is the simplest, but it doesn't mean that it's easy to execute. You know, simple and easy are two completely, completely different things. So I like things when they're cheap, when there's a real fundamental argument, but I also don't like to catch a falling knife. And so I like things when they're cheap, but also when they're going up. So let's zoom out, because I think this is a great lesson in what I've learned, and that might be applicable to you guys as well. So, you know, let's assume here in 2002, you think that silver, which was very, very cheap, we're going into a commodity super cycle. I wouldn't want to buy it in here at 480. I would have wanted to buy it here at 5, 6, even when, you know, even though it took a dip back down to 578. But that's when I would have wanted to buy, or even better, I would have wanted to buy here when you see a real breakout, or here when you're hitting all-time highs. So here, what you'd be doing is you try to catch this big move up. You do the same thing by buying right here at 40. So, you know, this is, and another thing that I've learned this year is that to to really have an edge over the market, you can't be a one-trick pony. So you can't just be a value. I mean, you can, but that's suboptimal. If you're just a value investor, you just buy things when they're cheap. That's great. You want to do that. You definitely want to buy things when it's cheap. But you also want to be able to have that skill set to where you can buy if the market is off sides due to something else, say panic, an unjustifiable panic, or sell when there's unjustifiable hysteria. Same thing. That's a different skill set. That's a different tool that you should have in your bag of tricks. So what I'm saying here, buying here when you got deep value, just an example, things are going up, you want to wait till here. That's a different than buying here when it's trading just over its all-time high, say at 22. This is more of a momentum trade. So this is more momentum. But you see what I'm saying is you should exercise that muscle. You should exercise the momentum muscle, but you should also exercise the value muscle, just making sure, at least this is not personal investing advice, this is just what I do, and this is what's worked really well for me this year. And I got to give credit, all the credit to Hugh and some of the other guys that I'm fortunate enough to hang out with in St. Bart's. And then there's other times, like more recently, actually, let me pull that up because that's something really, really good to discuss as well along the same lines. If you guys have been following Lennar today, this is another stock that I've been short. Rebel Capitalist Pro members know that very, very well. I took a short position in Lennar, maybe guessing 2 months ago, 3 months ago, something like that. And I offset it with a long position in the S&P 500. This is very similar to what Jim Chanos does. And I'm just trying to play the spread, right? So if we look at the year to date, you can see that this was, I think I did it right around here. I got this move down, but then it started to go against me, so I sold. Now I was up on the position. I wish I would have held it to today because you can see just today it's down almost 5% because they came out with earnings. Now, those of you who watch my channel, you're probably looking at this saying, well, duh, because every single time you've done a video on the housing market, George, you go to the Lennar website and it's nothing but price cut, price cut, price cut, price cut, price cut. So should we be surprised that they came out today with earnings that disappointed the market? That's kind of like the no-brainer of all no-brainers, right? But my point here is that this was another trade that worked really, really well. That wasn't necessarily an outright short position. It was more what they call a pairs trade. And so that's not a value play. That's not a momentum play. That's a spread play. And that's just another thing that if you can exercise that muscle, if you can build that skill set, that's just another tool that you have at your disposal, which if you take all the tools that you have in your bag, that's at the end of the day what gives you an edge. And the best traders and the best hedge fund guys that I've ever met in my life that are proven through decade after decade of just incredible performance. These guys have every single tool in the bag. Like there's not a tool in the bag that they don't have, that they can just look at something, see an opportunity, be like, oh, I just need to do blah, 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 because that's the opportunity there. And I'm not saying that you have time to do all that stuff, but for the simple things that we talk about in this channel or that I talk about in Rebel Capitalist Pro, just like a pairs trade or value or momentum, that is something that is definitely within your capability as a retail investor. That's just going to make you that much better. And quite frankly, guys, let's be honest, right? We're not living in 1980 when the Buffett indicator was like, what was it, 30%? I'm talking about market cap of the S&P 500, or maybe it's market cap of the whole stock market, but it's the market cap versus GDP. Remember back in 1980, that was at like 30%. So, I mean, you could have just been blindfolded and thrown darts and just been like a buy and hold guy, and you would have done incredibly well. You wouldn't really have to have any skill. I think those days are coming to an end. Whether we like it or not, there was never a free lunch. But even, the lunch back then was really easy to pay for. And today, heck of a lot harder to pay for. So you've got to have these skills. If you think that you're just going to be able to take 10% of your paycheck and allocate it to a passive index fund for the S&P 500 and just wake up in 20 years being able to retire a millionaire, maybe, but the probability of that is extremely low. Why? Because the valuations are so high. In fact, Josh, can you pull up my Twitter feed? And then I'm going to get back to silver.
Pull it up.
But I really think these ideas that we talk about, whether it's regarding silver, whether it's regarding the S&P, interest rates, bonds, whatever, they're just really, really important. And I want to make sure that we're just not talking about macro stuff and thought experiments and the mechanics of the monetary system and the economy in this on this channel, but that we're also talking about things that are very actionable for your portfolio. Just go to my recent retweet there from Michael Burry. Yeah, that's it. Pull that up. This was really interesting, guys. I had never seen this before, and maybe you have, but check this out. Josh, I think you'd find this interesting too. Burry posted this morning. He said, this is a very interesting chart, as household stock wealth being higher than real estate wealth has only happened in the late 1960s, late 1990s. And the last two times ensuing bear market lasted years. So you see what he's doing there, Josh? He's got the blue line represents the real estate percentage of net worth for the American public and aggregate total, right? And then the red line represents the S&P 500, or the equities as a percentage of net worth. So you see what happens is when the equities as a percentage of net worth get close to and then above the percentage of real estate in terms of net worth, that's another sign usually that the market, the S&P 500, the stock market, is extremely overvalued. And now you could say you've got some false positives here a little bit, and that's true. But I think it's just, you can't just look at this in and of itself and come to a conclusion. I think you've got to combine this with everything else. And this is just another data point that I had never even heard of. Have you ever heard of that indicator, Josh?
No, I actually saw you tweet this and I sent it to Ken to do a live stream on it on Monday.
Oh, did you?
Yeah.
Yeah, I thought it was really, really cool. Very insightful. And by the way, I subscribe to Michael Burry's Substack. So I've read a couple of them, are really, really good. And I'll be reporting to you guys as he comes out with more research and as I think it's applicable to the Rebel Capitalist audience. But let's get back to silver. That's what this video is all about. And there we are. So the question becomes, are we headed to 100? I've got this wrong. I will absolutely admit. Thankfully, I got the majority of this move through the GDXJ, through the gold miners, which had a similar move in here. But from, call it 40 to 60, I have not been a part of this, unless you want to consider just owning gold. I would definitely, now again, this is not investing advice. I'm just telling you guys what I'm thinking. You know what? Let's do this. Let's go to a trading view chart, because I'd really like to look at the candlesticks on this. So let's go to trading view and let's do PSLV. Just use that as a proxy here. That's the Sprott Physical Trust. So let's look at candlesticks and let's go back a year to date. Wow, you got a gap up today. That's good. That's good. Well, that is tempting, guys. That is very, very tempting. Well, let me stay focused here because I'm just trying to think this through in terms of my own portfolio. And the one thing that I definitely wouldn't feel like as though I missed out, like, oh, I don't want to chase it. Oh, it's, I would not think that. I would think this is a wonderful, incredible looking chart. And this, this could go, obviously it could go a lot higher. It could go a lot lower, but, yeah, my base case would be $100. That's a lot. Let me kind of cop out and say that I think there's a higher probability you hit 75 before you hit 50. I think that's probably what I could say as far as my confidence, or something that I could say with a certain degree of confidence, just based on the chart. I'm just very, very hesitant because, as you guys know, silver is far more industrial than gold. And and look at the labor market. I mean, the labor market is absolutely falling apart. That is not good for the economy. Probably not good for silver. But there's obviously something driving it. Now, it's not inflation. It's not the Fed QE or anything like that. If you actually look at history, silver and gold, they're not a very good inflation hedge in the short run. In the short run. In fact, often there's an inverse relationship between the CPI and gold and silver. But over the long run, of course, gold is a fantastic inflation hedge. But people think there's like an inverse correlation. So as soon as the CPI goes up, or there's a direct correlation, excuse me. So as soon as the CPI goes up, gold goes up as well, right? When, yeah, not really. Not really. And a lot of people think that gold goes up due to the, it being the opposite of the dollar. Not really. The only thing I can find is this counterparty. And right now, if I'm going to explain what's happening with silver, it's probably something to do with AI. It's something to do with people, usually with a catch-up trade, you got gold that goes first, you got the miners next, and you got silver that's last. I think that's probably a component of it. And also, too, I think Bitcoin really stole the show for so many years as far as kind of sucking up that retail capital, and that retail capital that was looking for the soup du jour, so to say, the next asset that could really give them outsized returns. And maybe you're starting to see a shift from Bitcoin back into silver. That's what would make the most sense to me. So I think what I'm confident in saying is that my base case is there's a higher probability you get to 75. I'm just looking at the chart. Then you get to 50. And as far as 100, that I think is probably a stretch. I think that's a stretch based on everything that's happening with the yield curve. Now, if we came out of a recession, then I think it's game on. Then I think it's game on. But until we get through that, the stuff hitting the fan, if that's what happens, then I'm very, very hesitant. That said, take it with a grain of salt, because the whole move from 40 to 66 now, I've completely missed. All right, guys, enjoy the rest of your afternoon. If you want more information about Rebel Capitalist Pro, this is the private investment community where we talk about all these contrarian strategies and talk about actionable stuff in there to help you protect and grow your wealth. I do that with my good friend Chris McIntosh, Patrick Sresna from Macro Voices, Jason Hartman, Brent Johnson, just name a few. We'll have Josh put a link in the description below. All right, guys, enjoy the rest of your afternoon. As always, make sure you're standing up for freedom, liberty, free market capitalism. We'll see you in the next video.